Topic of our today's session is exploring investment opportunity with MLD. For this, we have invited Mr. Shashank Singh, Product Manager, InCred. Now, I would like to request Sir to take the session forward. Over to you, sir.
Hi, good afternoon, everyone. So I have done a webinar or rather a call with Nivesh earlier as well with respect to MLDs. I'm not sure how many of you are new and how many of you are, attending this again. Obviously, the product at that time was completely different. So let me set some context first very quickly and then we'll jump into the product just so that, we don't just start randomly. So MLDs, also known as market linked debentures or also known as structured products, right? So when a client invests in an MLD, they get secured NCDs in their demat account. So MLD is nothing but a NCD, right? Only difference is in a normal plain vanilla NCD, your returns are fixed. In this, your return is not fixed, your return is conditional. And that conditionality is linked to an underlying index. That can be gold, Nifty, Bank Nifty. And whatever is the conditionality, it's predefined in nature. So simply put, when you invest in an MLD, number one, you get NCD in your demat account. Number two, you don't get a fixed return. You get a conditional return, which is linked to the performance of a underlying index, which can be Nifty or gold or Bank Nifty, whatever, depending on the type of product we have. And whatever is the condition on day one. At maturity, if the performance of the index is X, you make Y return, or if the performance of the index is A, you make B return, right? So that is why it's called predefined. Now, this month, we are doing 3 products from the InCred desk. In 2 of the products, the issuer is InCred Capital. In one of the products, the issuer is Pocketly. So very quickly, let me just cover on InCred Capital, show you the 2 products, then quickly talk about Pocketly and talk about that product. I hope you can see the screen. Right.
Yes, sir. It's visible.
Okay, thank you, sir. So InCred Capital is basically a diversified financial services firm, which has all our fee-based businesses. So wealth management, asset management, investment banking, broking, these are all part of InCred Capital group company. And all of these are profitable on their own. And obviously InCred Capital as an entity is also profitable. Basically, it's a fully diversified fee income platform of all our financial services business. So, like I said, it'll have wealth management, investment banking, capital markets, asset management, equity derivatives desk, right? Broking. All of these are part of InCred Capital. Quickly, if I have to tell you the numbers, net worth is around 850 crores. Revenue is around 770 crores. PAT is around 170, PBT is around 170 crores. And a debt to equity ratio of less than 1x, right? These are the rough financials of InCred Capital, which is the issuer of the paper, issuer of the MLD. Now, the first product that we have in June is basically a gold linked MLD idea. So your returns are linked to the performance of gold. The index that we are using is near month future of gold on the MCX, right? So basically, MCX gold futures is the index that I'm using to link my return. The tenure of this product is 36/42 months. So what do I mean by this 36/42 is, for 36 months or 3 years, we will look at the performance of gold. And basis the performance of gold, there will be a maturity payout on the 42nd month, right? Now, when we measure the performance of gold, there has to be a start level and an end level, right? So the start level of gold will be the average of 6 days spread across 6 months. So these 6 days will basically be the trade date, which is 1st of July, and then the last Thursday of July, August, September, October, November, right? 2025. This will be my average entry. And my average exit will be the last Thursday of Jan, Feb, March, April, May, June 2028, right? So point number 1 here is, this MLD, your underlying index is MCX Gold Futures. Point number two, tenure of the product is 36/42 months, which means there is an observation period of gold for 36 months and a maturity payout in the 42nd month. Point number four is that there is a start level of gold and a end level of gold. We don't want to take single entry exit. It will be too volatile. So we have a staggered sort of like a SIP and a SWP. So 6 months average entry, 6 months average exit. Now, what the product says is that after 3 years, if gold is positive, you make a 150% participation rate or you make a 150% PR. What that basically means is you make 1.5 times of gold return. So for every 1% that gold goes up by, you make 1.5 times of that. So for example, in this table, if you see, if gold goes up by 10% in 3 years, you make 10 into 1.5, 15% return. If gold goes up by 50% in 3 years, you make 15 to 1.5, 75% return. If gold goes up by 100%, you make 100 into 1.5, 150% return. अगर gold 200% ऊपर चले गया तो 200 into 1.5 मेरा 300% return हो जाएगा. So on the upside your returns are uncapped. Whatever is the gold return, you will make 1.5 times of that, or you make a 150% PR. Downside pay, you're protected up to a 10% fall in the price of gold. So after 3 years, if gold is down by negative 10%, you will still get your 100 rupees back. Okay. Now, after negative 10%, you will start losing capital, but you will always have that 10% ka buffer. So if gold is down by 11%, minus 11%, you're down by only -1. If gold is down by minus 20%, you're down by only -10. If gold is down by minus 15%, you're only down by minus 5%. Right? So simple product here. Underlying index, MCX gold futures, tenure 36-42 months, 6 months average entry, 6 months average exit, 150% uncapped PR. So you make 1.5 times of gold. So on the upside, whatever is the gold return, you make 1.5 times of that. On the downside, you are protected up till a 10% fall, beyond which you will lose capital if gold goes down by more than minus 10% in 3 years. But you will still maintain that 10% buffer, right? That buffer. Now, why does this product make sense? It clearly replaces your gold ETF, right? So if somebody is bullish on gold and they want to take gold exposure, they can take this through this MLD. Or if they have a gold ETF, they can book profits and deploy it here. Reason being, upside you make a 150% participation, you're making 1.5 times of gold. Downside, you're protected up till 10% fall, beyond which you have that 10% cushion. So obviously, you're better off in this than a gold ETF. This is product number one. You can ask questions or I'll move ahead. The second MLD, so the host, I would request you that if there are questions, please feel free to interrupt me or we can take it at the end, whatever you're okay with. Now, the second InCred Capital MLD that I have is a Nifty linked MLD. So similarly here, your underlying index is Nifty 50. Okay. The tenure is 36/39 months. So for 36 months, we observe the performance of Nifty, and in the 39 month, we have a maturity payout. Your average entry will be the trade date and last Thursday of the next 2 months. And average exit will be the last Thursday of the, we'll take an average of Nifty level, whatever is the Nifty level on the last Thursday of the 34th, 35th and 36th month. So we have a 3-month average entry, 3-month average exit, right? So 36-39 is the tenure here. Nifty 50 is the underlying index, 3 months average entry, 3 months average exit. Now, what this product says is on the downside, after 3 years, if for some reason Nifty is negative, then up till a negative 20% fall, your principal is fully protected, right? So even if Nifty is down by -5, -10, -20 in 3 years, your principal is fully protected. After negative 20%, you will lose capital with catch-up. So -21, you are at -21. If Nifty goes in by -22, you are at -22. On the upside, there is no participation rate. There are 3 slabs. So first slab is If Nifty is up by 5% absolute in 3 years' time, you make 10% return. If Nifty is up by 10% absolute in 3 years' time, you are at 27.5% return or 7.76% per annum. And if Nifty is up by 25% in 3 years, you make 55% return, which is an IRR of 14.43. Right? There is one question on the chat. I will come to it. So, like I said, the Nifty product 3639 underlying index Nifty 50, average entry 3 months, average exit 3 months, first three, last three. Downside protected up to 20% fall. Beyond 20%, you lose capital as much as Nifty. Upside pay, you have three slabs. 5% pay 10, 10% pay, you make 27.5% or 7.76% per annum. And 25% pay, you make 55% return, which is 14.43% IRR. Now, if I look at the backtesting data, right? So what I mean by backtesting data is we can do a rolling return analysis. We have the data of Nifty of the last 20-25 years. So we know how this product would have performed in the past. If you would have invested in the past, rolling return, like every day you invested for 3 years, and if you plot the data, how does it look like? Point number one, never has Nifty gone beyond negative 20% in 3 years. So even if you are the most unfortunate investor, at the time of investment or at the time of maturity, something like a COVID or 2008 happens, right? Your principal, you would still not lose more than minus 20% over a 3-year period. Second thing is, at 10% absolute Nifty return, you are making 27.5% return, which is 7.76% per annum. So you are making more than GSEC return annualized if Nifty goes up by only 10%. If I look at the backtesting data, that has happened 96% of the times. 96% of the times, Nifty will go up by at least 10% absolute in 3 years. The third slab, right? 25% pay, you make 55% return, which is 14.43% per annum. How many times has it happened that Nifty has gone up by 25% in 3 years? The answer to that is 83.5% of the time. Right? 83.5% of the times in the past, Nifty has gone up by 25%, giving you 55% in this product or 14.43% IRR. So why do I like this product? Three reasons. Downside protected up to 20% fall. So, and Nifty has not gone beyond minus 20 in 3 years in the past. At 10% Nifty movement, you make 27.5% return, which is GSEC plus return annualized. And this has happened 96% of the times in the past. And 25% Nifty return, you make 55% return, which is 14.43% IRR, which has happened 83.5% of the times in the past. So 0% of the time Nifty has gone beyond minus 20. 96% of the time Nifty has given 10%. You make 27.5%, 7.76% per annum GSEC plus return. And 83.5% of the times you make Nifty gives 25% return. You make a 55% return, which is 14.43% IRR. Right? So this is the second product. Now the third product, if I can go to that, there the issuer is Pocketly. So Pocketly is basically a fintech platform for an NBFC, which does really, really small micro loans to blue collar workers and entry level white collar workers with loan size of literally from 500 rupees to 5,000 rupees with the loan tenure of 1 to 3 months or 1 to 6 months, right? So very, very small micro loans to salaried employees is what Pocketly, the fintech platform for the NBFC does. Now this is a gold MLD by Pocketly. Everything else remains the same. 36-42 months underlying index MCX gold futures, 6 months average in, 6 months average out. Only difference is on the downside, your principal is completely protected. So no matter where the gold goes, negative 10, negative 20, negative 30, you make your 100 back. Upside pay, you make a 170% PR. So you make 1.7 times of gold. So if gold goes up by 10%, you make 17. If gold goes up by 50, you make 15 to 1.7, 85. 100 by 170. So whatever is a gold return into 1.7, right? So to quickly recap, there are three products. First two products issued by InCred Capital, third product issued by Pocket Lead. First product issued by InCred Capital, Gold MLD, underlying index, MCX Gold Futures, 3642, 6 months average in out, principal protected up till 10% fall, upside uncapped 150% PR. Second product is again issued by InCred Capital, 36-39 months, 3 months average entry, 3 months average exit, downside protected up till a 20% fall, 3 slabs here. At 5% you make 10, at 10 you make 27 and a half, at 25 you make 55. IRR of 14.43. Third product issued by Pocket Lead, again a gold MLD, underlying index MCX gold futures 36.42, 6 months average in out, downside fully protected, upside 170% PR. Right? So these were the three products. Now we have a question in the chat by Sanjay Malani. Gold is at its peak. 3 years down the line, the value of gold will be $3,400 an ounce, question mark. So gold has run up a lot in the last 6 months to 1 year, but we are bullish on gold, still bullish on gold. If you look at right now, gold is trading at around $3,300 an ounce. If you look at the JP Morgan report, gold is expected to go to $4,000 an ounce next year and even higher the year after that. The reason for that is obviously you can see a lot of wars going on. There is a global trade war going on, initiated by President Trump, and a lot of central banks are buying gold. So if you look at the data, for every 200 tons of gold purchased in a quarter, the price goes up by 2%. Central banks are expected to buy 900 tons of gold in the next calendar year. So a lot of central banks buying gold, and with the global uncertainty, both in terms of trade war and wars, multiple wars happening across the world, uh, I think everyone in the market, a lot of international banks, AMCs, everyone is very bullish on gold, Sanjay. Any other questions, friends? Can you explain what goes on? Yeah, sorry.
Dear participants, you can ask your questions in the chat box, or you can raise your hands also. I will allow you to unmute yourself.
So can you please explain what goes on in the back end? So a market linked debenture or an MLD or a structured product, it's a mixture of two things, debt and derivative. Now, depending on the tenure of the product and the design of the product, there is a split. So if client gives me 100 rupees on day one, the split will be 90-10, 85-15, 75-25, 70-30, right? Depending on the design and tenure of the product. So let's take an example. Client gives me 100 rupees on day one. I deploy 70 rupees with the treasury, which parks it into a basket of, fixed income instruments, bonds, right? So that 70 grows to 103 and a half years. Then I sell a put option at -10. I collect some premium of 5.5 rupees. And along with the 30 rupees I've kept aside, for 35 rupees, I'm buying call option. So basically what's happening is I take 100 rupees from the client on day one. Most of the money is parked into the treasury, which grows back to 100 by the time the maturity of the product is done. With the remaining money, we pay premium to buy call options. And sometimes we also sell put options at the bottom to collect premium and buy more call options. Right? So that's how the design of the product is done. And that's how we know on day one that at maturity, what is going to be your return at different index levels. Because we do all the hedging on day one itself. So I hope that answers the question.
So we don't have any questions.
Any other question? Okay. Okay, then thank you.
Thank you, sir, for joining with us, and thank you to all the participants also. So there is a question
Thank you.
from Umesh.
Is it easy to buy long dated options? So, couple of things, Umesh. So, long-dated options are generally not liquid, especially not for retail clients. So, because we are an institutional, I mean, we are institutional hedging desk, right? So, we will have tie-ups with other institutional hedging desks. Now, I can't take names, but there are various international banks and NBFCs who also want to do long-dated options. So that's how we are able to execute this trade on the NSE. And these long dated options are not always available on the exchange. So when these long dated, so if these long dated options are not available, then we do something called as delta hedging, right? So jab tak that long dated option is not liquid, till that time we will do delta hedging, where we will synthesize the option price by uh, holding that many amount of futures to replicate that option price. So there is a hedging desk which looks at obviously all of this, where if long dated options are not available even through institutional investors on NSE, we are able to do the hedge through delta hedging using futures.
So there is another question also from Manju Bachi.
It seems like a comment more than a question.
Okay. So that's it for the question.
Yeah, I don't think it's a question. It looks more like a comment.
Okay, sir. So, sir, thank you for joining with us, and thank you to all the participants also.